Did the Fed drop the ball because it didn't see the risk that was building?
Fundamentally, the bank failed because its management failed to appropriately address clear interest rate risk and clear liquidity risk. That interest rate risk and liquidity risk was highlighted by the supervisors of the firm beginning in November of 2021. The board the Federal Reserve Bank brought forward these problems to the bank, and they failed to address them in a timely way. That exposure led the firm to be highly vulnerable to a shock, and that shock came on the evening of Wednesday, March 8th, when it very belatedly attempted to adjust its liquidity position and reported losses on its available-for-sale securities. The market reaction to that was quite negative, and that eventually on Thursday sparked a depositor run.
How poorly managed was this bank?
Supervisors had rated the bank at a very low rating. Normally, we would not be describing these matters, confidential matters, but given that the firm failed and triggered a systemic risk determination, I'm prepared to talk about that confidential information. That the firm was rated a 3 in the Campbell scale, which is not well managed. And at the holding company level, it was rated deficient, which is also clearly not well managed.
What would have been the impact on small banks and small businesses across the nation if you and other regulators had not taken action to protect depositors at SVB and Signature Bank?
Senator, that was our central concern. I think the evidence suggested from the sequential failures of first Silicon Valley and then Signature that there was a significant risk of contagion to other institutions. And in fact, over that weekend, we were seeing serious stress at other institutions. And I think that and the potential knock-on effects of that contagion is really what led the Federal Reserve Board and the FDIC Board unanimously to recommend to the Treasury Secretary.
So you're saying the actions taken were the least bad option for small businesses and banks across the nation. If you hadn't acted that way, you think there would have been a contagion?
I think there would have been a contagion, and I think would be in a worse situation today with consequences for the actors in our economic system that you referenced.
Regulators, Republicans, Democrats, all across the board, there was agreement on those actions.
Yes.
Undersecretary Lang, do you agree with that?
Senator Brown, I do agree with that. I think the actions that were taken have been working to stabilize deposits. Had they not been taken, the runs by uninsured depositors from many small and regional-sized banks and mid-sized banks would have intensified and caused serious problems for small banks' liquidity and their ability to support small businesses.
Estimated would cost the Deposit Insurance Fund approximately $20 billion. How's that cost covered?
Oh, that is required by law, and I indicated in my opening statement. The FDIC has to impose an assessment on the banking industry to cover the cost of a coverage for any uninsured deposits. And I would note that the law provides the FDIC authority in implementing that assessment to consider the types of entities that benefit from any action or assistance provided. And as I also indicated in my statement, we expect to issue a notice of proposed rulemaking for public comment in May to implement the assessment.
Thank you.
What is the future of regional banking? Sure.
I think we have a strong set of regional banks in the United States. I think it was, and as a general matter, their liquidity has remained stable through this episode. And I think it was a good indication, frankly, that in the two failed institutions, in both of those cases, the strongest bids we received to acquire those failed institutions were from two other regional banks that had the capability and strategic business interest to acquire them. So there are a lot of cautionary lessons to be learned from the Senator. I completely agree with that. And we're going to need to carefully review this episode. But as a general proposition, I think the regional banks in the United States remain a source of strength for the system.
Were there folks interested in buying Silicon Valley Bank on Friday?
Senator, just to be clear, before the bank failed on an open institution basis?
After,
After the failure on a closed basis?
yes.
We had expressions of interest. I mean, remember, this was a very rushed process, if I may say. The bank failed on Friday morning. We had to, the other institution failed over the weekend. We had to set up 2 bridge institutions to manage those failed banks. To your point, though, we had expressions of interest. We quickly set up a bidding process that we ran on Sunday. We received 2 bids. One wasn't valid because it had not been approved by the board of the bank, and the other, after we evaluated it, indicated that it was more expensive than a liquidation of the institution would have been to the FDIC. So in effect, we did not have an acceptable bid, and it was really a determination that we made to try to set up 2 bridge institutions to manage for a short period of time these 2 failed banks, and then to organize a bidding process, an open bidding process for both institutions, which we ultimately were able to implement successfully and sell Signature Bank previous weekend, 2 weekends ago, and then to sell SVB this past weekend.
Are you suggesting that the fact that the board had not approved the decision off the offer that was on the table was the primary reason why you turned down that offer?
It was one of the bids. As a matter of, we were required for a bank to make a valid offer for the
Yes.
board of the bank.
To approve the offer?
Yeah, as a
That
matter
was the
of
primary reason why you did not go
For that,
one?
for that bid, the other bid did not have that issue, but the other bid was more costly than liquidation would have been.
So you're suggesting that a private sector engagement would have increased the cost, not decreased the cost?
At that point, I think in part because it takes a bit of time for, this was a substantial institution, it takes some time for a bank to do appropriate due diligence, to evaluate the assets and liabilities, and to make an informed bid for the institution. And I think as a practical matter, that was difficult to do given the compressed time frame over that initial weekend. I think that's why we set up the bridge institutions to try to put in place quickly an orderly bidding process where any interested party could submit a bid, have an opportunity to do due diligence in order to evaluate the institution, and to make an informed bid. I think we were ultimately able to do that for both of these failed institutions.
I'll just say,
Vice Chairman Barr, can you take us through with a little more detail, starting Wednesday night through Friday afternoon, how this happened, how we got here, and what you've seen so far?
Thank you very much, Senator. I'll start where you did, which is this is a textbook case of bank mismanagement. The risks the bank faced, interest rate risk and liquidity risk, those are bread and butter banking issues. The firm was quite aware of those issues. They had been told by regulators. Investors were talking about problems with interest rate and liquidity risk publicly, and they didn't take the action necessary. They were quite vulnerable to risk, to shocks, and they didn't take the actions necessary to meet that. What happened on Wednesday night is they belatedly attempted to improve their liquidity position, and they did it in a way that spooked investors, that spooked depositors, that spooked the market. Nonetheless, on Thursday morning, things appeared calm, according to the bank's report to supervisors. But later Thursday afternoon, deposit outflows started. And by Thursday evening, we learned that more than $42 billion, as you had indicated, had rushed out of the bank. That's an extraordinary pace and scale. Federal Reserve Bank staff worked with the bank through the afternoon, evening, and overnight to try and find enough collateral that the Federal Reserve could continue discount window lending against. On Friday morning, it appeared that it might be possible to meet the outflow that was expected the day before. But that morning, the bank let us know that they expected the outflow to be vastly larger based on client requests and what was in the queue. A total of $100 billion was scheduled to go out the door that day. The bank did not have enough collateral to meet that, and therefore they were not able to actually meet their obligations to pay their depositors over the course of that day, and they were shut down.
My question to you is, was there any statutory restriction faced by the Federal Board of Reserves as it issued its regulations on tailoring that would have prohibited them from applying the strictest standards they could to address the prudential needs of our banking system?
Thank you, Senator Crapo. I agree with you. There was substantial discretion under that act for the Federal Reserve to put in place tailoring rules that were different from the tailoring rules that it put in place in 2019. I think there is still to this day a substantial discretion in changing those by notice and comment rulemaking. That's one of the areas that we'll be looking at in our review, whether there should be appropriate changes. There are some areas for, particularly for smaller firms between 50 and 100 billion, where the act is more prescriptive. But for the firms of the category that we're addressing today, there's substantial discretion for the Federal Reserve to change those rules in a way that is supportive of safety and soundness and financial stability.
Thank you, and I appreciate your answer. You said recently that the bank failed, referring to SVB, as the public began to focus on changes in values of securities in the bank's held-to-maturity account. That's correct, right? My question to you there is, did the standards on that risk that are used for supervision, were those changed at all in Senate Bill 2155 in 2018?
The standards for capital rules are determined by the bank agencies. The bank agencies made a decision to, for smaller categories of these large banks, to not require the pass-through of AOCI into the capital structure. But that was a decision that is available to be altered by the discretion of the bank agency.
And was not mandated by 2155?
No, it was not mandated by 2155.
Last question is, under the current standards that are applied with regard to capital, was SVB adequately capitalized?
Prior to its failure, it was categorized under current capital rules as well capitalized.
Is the Federal Reserve the appropriate body to conduct this investigation, or should we have an independent investigation?
Describe what we're doing as a review. We're reviewing our own practices. I think it's an important part of risk management to do self-assessment. I think it would be irresponsible and imprudent of us not to do self-assessment. We're going to take that very seriously. We're going to be thorough, we're going to be transparent, and we're going to be far-reaching in that self-assessment. I also think it's appropriate for outsiders to have independent reviews, and we expect and welcome independent reviews of our actions.
And if you uncover in your investigation that the Federal Reserve failed here in some of its supervisory roles, will you make that public?
Yes, we intend to make our report fully public on May 1st, and that report will include, normally it's not our practice to include, but that report will include confidential supervisory information such as the exam reports.
And in the scope of your review, you identify the scope of that review in your written testimony. Is there anything in addition that's not in your written testimony that you will be reviewing here in that scope?
Thank you, Senator. I've asked the staff to be far-reaching. So if they determine that an issue should be in scope, they have full discretion to put that issue in scope and to address it in the review. So there are no limitations on their ability to review how the Federal Reserve conducted its supervision and the regulatory oversight of the firm.
Thank you. And then one final thing, because there's been a lot of discussion about the previous rollback of some of the regulation in votes in this body just recently. If you find that that change in the law impacted the Federal Reserve's ability to conduct the appropriate tests based on the tiering of the bank's assets, would you be forthcoming with that and say so?
Yes, we intend to describe where we think supervisory and regulatory failings occurred. If changing those to make them what we think is the right standard would require an act of Congress, we will say so in that review.
And then Chairman Grunberg, same to you. You're conducting a scope of the FDIC. Are you comfortable that you can conduct that and be transparent and accountable, or should there be an independent body looking at this?
I think there's room for both. As Michael indicated, I think it's important for each of our agencies to look internally at our supervision of these institutions and draw lessons from it. In our case, we've asked our chief risk officer, who's not directly involved in the supervision process and whose role is to evaluate risk at the FDIC, to undertake this internal review of our supervision of Signature Bank.
My first question is, what authority do you have to claw back any of those bonuses or the executive pay, or even deal with the sale of the stock? And maybe, Mr. Grunberg, let's start with you and then go down.
Thank you, Senator. You know, as I indicated in my opening statement, the FDIC, for every failed institution, is required to undertake an investigation of the conduct of the members of the board, the management of the institution, as well as professional service providers and other institution-affiliated parties. We've already begun that investigation, and we have significant authority under the law, depending on the findings of the investigation, to impose civil money penalties, restitution, and as well bar individuals from the business of banking. So the authorities are substantial, and we're going to pursue this as expeditiously as we can. I know there's interest. We do not have, under the Federal Deposit Insurance Act, explicit authority for clawback of compensation. We can get to some of that with our other authorities. We have that specific authority under Title II of the Dodd-Frank Act. If you were looking for an additional authority, specific authority under the FDI Act for clawbacks, probably would have some value here.
The board does have authority to pursue actions against individuals who engage in violations of the law, who engage in unsafe or unsound practices, who have engaged in breaches of fiduciary duty. We retain this authority even after a bank fails. And we stand ready to use this authority to the fullest extent based on the facts and circumstances. And as with Chair Grunberg, potential consequences include a prohibition from banking, civil money penalties, or the payment of restitution. We intend to use these authorities to the fullest extent we are able.
Yes, I defer to the FDIC and Federal Reserve on this.
My question, Vice Chair Barr, was managing interest rate risk listed in the MRIA section of the supervisory finding issued to SVB? And if it was not, why not?
Senator, we're still reconstructing the supervisory record. We've just started the review, but my understanding is that they were issued a matter requiring immediate attention based on the inaccuracy of their interest rate risk modeling. Essentially, the risk model was not at all aligned with reality.
What's the time frame that's expected for a response for an MRIA, one that requires immediate attention?
Senator, there's not a fixed amount of time. It depends on the issue, the scope of the issue, the complexity of resolving the issue. So I don't have a way of giving you a firm baseline on the action, but they're expected to be a top priority for management to address. And particularly in the interest rate environment that we're in, and knowing that the firm had been cited previously for other problems with liquidity risk management and interest rate risk management, supervisors would expect that would take a high priority attention by top management. The supervisors met with the CFO of the firm in the fall, in October of 2021, to convey the seriousness of the findings directly.
During this time period, perhaps for as much as 6 months during that previous year, the bank was without a risk management officer. Is that correct?
That's my understanding. I think it's terrible risk management, obviously, not to have a CRO at the firm. You need an effective CRO as part of risk management of the firm. And as I indicated previously, the supervisors had told the firm in the summer that they had deficiencies in governance and controls at the management level and the board level, and that was related to their failure to appropriately manage risk.
My understanding is that there was a period of time there in which they were without a CFO as well. Is that correct?
I don't have the details of that, but I'm happy to get back to you.
Okay. There clearly is a defined difference between a matter of such importance that it requires immediate attention versus one where it requires attention. Can you talk a little bit about what the expectations are between the two?
They both really signal that bank management should pay attention to what's in front of them. They're not issued lightly. A matter require immediate attention is, as its name suggested, telling managers that they should place a priority on fixing this issue over other issues. But the exercise of the line between the two is a matter of supervisory judgment.
Just there is an expectation that the board or the executive officers would respond fairly quickly. To your knowledge at this point, was that expectation met?
Well, I think the fundamental fact is, the firm failed because of its interest rate risk and its liquidity risk, and that is, I think, evidence of the fact that they didn't respond strongly enough and promptly enough.
In other words, with the information that you had and that the regulators had, they were able to determine that there was a problem at the bank, and they directed that there be a response immediately, an immediate response, based upon the data that they were able to gather at that time. That's a reasonable assumption, is it not?
I don't know what the time frame set out in each of the individual orders were, so I'm not able to answer your question with precision, and I want to be very careful to be able to do that.
That's fair.
And not go beyond the
Let me
record.
just
But
finish this, though. But we will receive that information when the full report comes out.
yes, on May 1st, we'll release the full report, and it will include the reports of examination, and so people will be able to see what's in the record.
So with a simple yes or no, can you tell me that the situation at Silicon Valley Bank posed systemic risk?
Thank you, Senator. I think it's an absolutely crucial question. The invocation of the systemic risk exception required judgment as well as incoming data. And our best assessment, the assessment of a unanimous Federal Reserve Board and a unanimous board of the FDIC and the Treasury Secretary, was that we were seeing signs of contagion in the banking system that threatened to put at risk depositors and banks across the country. And to make sure that banks could continue to lend in their communities, to make sure that depositors were safe, to make sure that businesses could pay payroll, well, we thought it was important to invoke that systemic risk determination and prevent that.
You felt that Silicon Valley Bank was a systemic risk at that point in time?
The judgment was really broadly about the risk that the failures of these institutions and other stresses in the system were posing as a whole, as opposed to a particular decision.
It seems to me that. Do you agree with President Biden's statement 2 weeks ago that Congress should strengthen rules for banks to make it less likely that we will see another failure similar to that of Silicon Valley Bank?
Thank you, Senator. I think it's important for us to strengthen capital and liquidity rules. We're working on strengthening them as part of our Basel III reforms and our holistic review of capital. And I think we need to move forward with that. And as both Chair Grunberg and I suggested, with a long-term debt requirement that would provide an additional cushion in addition to capital for large institutions. That work will need to go through notice and comment rulemaking. There will be transition periods for it, but I think that is really important work for us to do, and I'm committed to doing it.
Do you agree with Chairman Powell's statement last week that from what we know, it is, quote, clear that we do need to strengthen supervision and regulation?
Yes, I absolutely agree with that statement.
Thank you. At the end of the day, it seems that we are incentivizing entities to go to too big to fail banks. It only makes it even more consequential in terms of too big to fail. Is that what we want to ultimately achieve in this process?
Senator, I think that the goal of the actions that we took are to make sure that we have a thriving and diverse system of banking in the United States, including community banks and regional banks that are the lifeblood of many communities all across the country.
The Federal Reserve rather stress tested 34 banks in 2022. Is that correct?
Senator, I don't have the exact number in front of me, but that
Well,
sounds,
I have your
that
report.
sounds, that
I have
sounds
your
correct.
report. It says 34. And the cutoff was $100 billion. Is that right?
Yes.
Okay. You didn't stress test Silicon Valley Bank, did you?
No, under the Federal Reserve Board's rules that were put in place for transition into the stress testing, it takes a while for a firm to be considered above the threshold. Yeah. They need to have a rolling four-quarter average.
Did you stress test Silicon Valley Bank in 2022?
No.
Okay. Silicon Valley Bank had $100 billion, more than $100 billion in assets at the end of 2021, did it not?
Senator, as I was explaining, the transition rules in place at the time require a rolling four-quarter average to be above that amount.
Okay.
And then if the firm happens to be in a year that isn't the year that, since it's an every other year test, that a test is running, then it waits till the next year. So for Silicon Valley Bank, that would have meant 2024 would be its first stress test.
But the point is, you didn't test Silicon Valley Bank.
We did not apply a stress test to Silicon Valley Bank. It was, of course, using its own stress test.
Did you have the authority to do it?
Under our existing regulations, no. We would have to change our regulations to have that authority.
Under the Congress's amendment to Dodd-Frank, Senator Crapo talked about it, 2155. Section 252.3, isn't it a fact that we gave the Federal Reserve the authority to stress test Silicon Valley Bank?
Under that legislation, the Federal Reserve could have put in place a rule defining the word periodic,
but you
in
didn't.
a different way than was done.
Right, but you didn't, did you?
The Federal Reserve did not do that.
Okay. If you had stress tests, let me put it this way. If you had stress tested Silicon Valley Bank in 2022, it wouldn't have made any difference, would it?
I don't know the answer to that question.
Well, you didn't test for Silicon Valley Bank's problem. I've read your report. Your stress test, you stress tested these 34 banks for falling GDP, spike in unemployment, and defaults in commercial real estate. Isn't that correct?
Yes, in a typical adverse scenario for banks, we're testing falling interest rate
But that
environments.
wasn't our problem in 2022.
I completely agree
and
with
it's
you.
not our problem today. The problem is inflation, high interest rate, and loss of value in government bonds, isn't it?
I completely agree with you.
So you stress tested in 2022 for the wrong thing.
The stress test is not the primary way that the Federal Reserve or other regulators test for interest rate risk.
But you stress tested for the wrong thing.
As I said, Senator, I agree with you that it would be useful to test for higher rising interest rates. That's why in our alternative scenario, multiple scenario that we put in place for this year's stress test, we do that. These decisions were made before I arrived, but I agree with you that it would be
But it's like
better to
somebody
do that.
going in for a test for COVID and getting a test for cholera, isn't it?
I don't know enough about either of those tests to know.
Yeah. Well, they're different. So all this business about, well, the amendment to Dodd-Frank kept them from stress testing. The way I see it, you chose not to stress test, and if you had stress test Silicon Valley Bank, you wouldn't have caught the problem.
As I said, Senator, I agree with you that the statute requires periodic stress testing. The Federal Reserve made a decision about how to implement that in 2019.
Right.
That resulted in SVB not being tested planned to be tested until 2024. Well, but as I said, the stress test requirements.
You knew from the. I'm sorry to cut you off, but the chairman's going to cut me off in a second. But you knew the Federal Reserve knew well in advance that Silicon Valley Bank had a problem with holding too much of its money in interest rate sensitive long government bonds, didn't you?
I think the investing public and the Federal Reserve, which cited it for interest rate risk problems, knew that it had interest rate risk. I think
The Federal
nobody
Reserve didn't
anticipated
do anything
a bank-
about it, did it?
I'm sorry, I couldn't hear
The
you.
Federal Reserve didn't do anything about it, did it?
I disagree with that, Senator, respectfully. The Federal Reserve did cite these problems to the bank and require them to take action. Bank management failed to act on those.
You didn't follow up,
citations.
did you?
Vice Chair of Supervision put into place rules that I think there's a question about whether those rules, I mean, I think even in the moment, you were critical of those rules. Is that right?
Yes, that's correct.
And so your review will take a look at what would have happened if those rules hadn't been in place, and then you can make decisions about what new rules need to be in place to protect from this kind of extraordinary situation that we saw with these two banks. Is that correct?
Yes, that's correct, Senator.
So I think that's just important for us all to understand here as we think about what has happened. Talk about how the Fed right now and others are monitoring that interest rate risk and what that tells you about where we need to do differently.
Thank you, Senator. Let me just start with the basic point, which is the banking system is sound and resilient. Most banks are highly effective in managing interest rate risk and liquidity risk. It is the bread and butter kind of work of bank management. So we are monitoring the financial system, monitoring the banking system. We're looking at interest rate risk and liquidity risk across the banking system to assess that. Where banks need to do better at interest rate risk and liquidity risk management, we're pointing that out. But I think the fundamental point is the banking system is sound and resilient.
Mr. Barr, can you talk about the risks of interest rate, sort of this interest rate risk, as it might affect non-banking institutions, as, for example, mortgage loan companies?
Thank you. First, let me just say, as you indicated, I hear from community bankers as well, and I know many other senators have in your home states, the vibrancy and the health of that community banking sector, and we see that too. We are obviously looking at interest rate risk as it affects not only banks but also the non-bank sector. We look at, of course, at non-bank mortgage servicers, we're looking at hedge funds, we're looking broadly across the financial landscape to see where those risks might arise and how those might propagate in other ways into the banking system. So we're highly attuned to that. But again, I think the basic point is that the banking system is sound and resilient, depositors are safe, and we've, through our actions, demonstrated that.
As I look at what authority you've been given, I can't think of another additional rule or regulation or law that you needed. Tell me whether you agree with that or not.
Senator, I agree that the Federal Reserve has substantial discretion to alter through notice and comment rulemaking the rules that were put in place in 2019. With respect to firms over $100 billion. There are some areas that the statute would provide some limitation to, but there is substantial discretion for the Federal Reserve to change its rules for firms in the $100 to $250 billion range.
Change its rules. What would it have to do?
We would have to go through a notice and comment rulemaking process.
I don't mean the procedure for changing a rule. I mean, what changes would you make to the rule?
Senator, we haven't made a definitive conclusion on that. We're undertaking this review of SBV's failure in order to better assess whether it would be appropriate to change capital rules and liquidity rules for this size firm, for firms more generally. We're looking at that right now.
Is fractional reserve banking overly risky in this age of online banking?
Senator, let me just say, repeat what I said before, which is that overall the safety and soundness of the banking system is strong. Banks are safe and sound. Depositors should feel assured that their deposits are safe.
Well, here's the problem, though. As I see it, the way that these banks have been managed, Wyoming's community banks may end up paying for this through higher assessments from the FDIC. Am I correct, Mr. Grunberg?
Well, as I indicated, Senator, in regard to these two institutions, any cost to the Deposit Insurance Fund from covering uninsured deposits is required by law to be recovered through an assessment on the banking industry.
Exactly.
If I make just one additional point, the law does give the FDIC authority in implementing that assessment to consider the types of entities that benefit from any action taken or assistance provided.
So are you saying that you're able to exempt Wyoming's community banks from paying for this?
I'm suggesting we have some discretion there, and we're going to consider that issue carefully.
Will you exempt community banks from having to pay for this?
That's a judgment our board is going to have to make. And as I indicated, we anticipate going out for notice and comment public rulemaking in May to implement the assessment. And as I indicated, we have discretion
Do you
here
have
under
to
the
go
law.
through APA rulemaking to assess?
That's the law. That's a legal requirement.
Vice Chair Barr, let me start with you. Do you believe we should strengthen our financial rules going forward?
Yes, I do, Senator.
Do you agree with President Biden that we need to strengthen our banking rules?
I do agree, Senator.
Good. And now, Under Secretary Liang, do you agree with the president on this?
Senator, I agree that we do need to prevent these types of bank failures.
Well, I'm asking
And-
you, of course we need to
and
prevent them,
strengthen
but,
supervision
but
and
that's
regulation.
not by simply wishing it. It's by stronger regulation, is that right?
I agree, Senator.
Okay, good. As you use your authority to strengthen the rules for the largest banks in this country, will you be reaching banks with assets of at least $100 million, $100 billion?
Senator, we, of course, would need to go through a notice and comment rulemaking.
I understand.
In this process, but I anticipate the need to strengthen capital and liquidity standards for firms over $100 billion.
Chairman Grunberg, will you commit to using your authority to undo the rollbacks that your predecessor initiated and to strengthen the rules and supervision for banks with greater than $100 billion in assets?
Senators, I think you know I was a member of the board at that time and voted against those measures. And I certainly think it's appropriate for us to go back and review those actions in light of the recent episode and consider what changes should
Well,
be
I have to say, review sounds a little wishy here. You didn't think they were good rules to begin with.
My views haven't changed, Senator.
All right, so you still think they were a bad idea?
I do.
Got it.
So my first question, in the joint statement released on March 12th, you said, quote, no losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. Is that still your position?
Senator, yes, as you know.
Well, this makes me wonder what prevented the FDIC from coming to a deal like this 2 weeks prior. You told Ranking Member Scott that you received bids for SVB over the weekend following its collapse, but that they were insufficient. What was your counteroffer? And did you engage with the board of the bank that didn't approve this to get them to step up and approve it?
We received one offer that was frankly more expensive than the cost of liquidation. It didn't appear to be a viable offer at that moment.
Was there a counteroffer to that?
I would have to check with our staff in terms of how much of a back and forth occurred.
Let's talk about the bidding process itself. Were certain banks dissuaded by you or anyone else associated with this from bidding on SVB, either before or after the bank was taken into receivership?
No, Senator.
So, Mr. Barr, in your review of what went wrong in your supervision, will you consider the level of managerial distraction that was evident at the San Francisco Fed?
Senator, the staff have free rein to examine any issue that might have addressed supervision. I think the core issues are the ones I suggested at the outside, and they're really basic. Interest rate risk mismanagement by the bank, liquidity risk mismanagement by the bank. The San Francisco examiners, the examiners at the San Francisco Federal Reserve Bank called those issues out to the board, called them out to the bank, and those actions were not acted upon in a timely way. And so I think, in
I hope you'll
a way, the
dig
issue is
into
pretty
the urgency,
straightforward.
the sense.
It seems that federal regulators were flagging concerns about this situation. Is that a fair statement, that for 2 years that the Fed was flagging concerns about this bank's financial viability?
Senator, the examiners were focused on interest rate risk and liquidity risk at the beginning in November 2021. There, at least as far as I know from the supervisory record thus far, I have not seen something that said that the supervisors were focused on whether the firm was viable. But our review is underway.
But doesn't that impact the viability?
Yes, Senator, is a core safety and soundness risk. A liquidity risk and interest rate risk are core risks that the bank mismanaged.
So were the regulators physically in the bank? So I've talked to a lot of intermediate-sized banks. They tell me that the regulators are right there 5 days a week, 7 days a week if they're open 7 days a week. Were the regulators in that bank?
Physically speaking,
Yes.
I actually don't know. The part of the supervisory period is during the pandemic when activities were happening
I've got you.
in part remote. So
Okay.
I don't have yet, but we will
But
have.
I just want to point out the fact that the pandemic's been over for quite a bit, and the opportunity for those regulators to be in there would have been long before a month ago.
Yes, Senator, I don't have the full supervisory record. We've just begun our review, and I want to be very careful to answer only questions I know.
Do you know if the Fed supervisors met with the board of directors of Silicon Valley Bank?
I don't know that yet. I know they met with senior management, but I'm still reviewing
So
the
you
record.
wouldn't know if Silicon Valley Bank had a risk committee, and if in fact the Fed supervisors met with the risk committee?
I will know that by the May 1st report.
So were they warned about potential fines?
I'm sorry, could you say that again?
So, I mean, look, they had some problems. Were they warned to either fix them or they were going to get fined?
The matters requiring attention and matters requiring immediate attention, to my understanding, require the fixing of the problem, but I don't know whether they've highlighted any additional steps that might be taken. Certainly, the firm was on notice that they needed to fix those problems quite clearly since November of 2021.
But yet they didn't.
They did not.
For over a year, regulators were saying to this bank, straighten up and fly right, and they never did a damn thing about it. And the regulators didn't make it so damn miserable, which my understanding is regulators are pretty good at that when they want to be, make it so damn miserable that these folks would adjust their business plan to take care of the risk that was in their bank.
Senator, I agree that the risks were there, that the regulators were pointing them out, and the bank didn't take action. It's ultimately, in the first instance, the bank management responsibility to fix these problems, and they failed to do it. Where we didn't take enough action, if the Federal Reserve supervisors didn't take enough action, we're going to be talking about that in our review, and we expect to be held accountable for it.
But it looks to me like, I'll just tell you this, and I'm looking out from the outside in, it looks to me like the regulators knew the problem, but nobody dropped the hammer.
Thank you, Senator Tester. As I said, our review is going to be thorough, it's going to be open, and if we find problems like the ones that you just described, we're going to say it clearly and describe what we think should be done.
When do you think that report will be done? And I'm way over time, sorry. When do you think that report will
May
be done?
1st.
At what level do you think uninsured deposits, in theory, are effectively unlimited uninsured in our banking system today?
Well, if I may say, Senator, you're asking important questions. I think we have a lot of lessons to learn from this episode. The decision to cover uninsured depositors at these two institutions was a highly consequential one.
Yes.
That has implications for the system. I think we need, and I indicated in my statement earlier, we need to do a comprehensive review of our deposit insurance system and consider the questions that you raise. The FDIC is going to undertake that, and by May 1, we'll deliver a report including policy considerations to take into account. So we want to try to be responsive on that.
Thank you. Mr. Barr.
I also think you raise important questions. When we were looking at the systemic risk determination with respect to these institutions, we were thinking about the risk to the broader financial system, not the particular depositors at one or two institutions. We're thinking about and concerned about the extent to which that could impact regional banks across the country, community banks across the country. We were hearing concerns from bankers and from depositors, from businesses around the country. It's a difficult judgment, but one that, at the end of the day, a unanimous FDIC board and a unanimous Federal Reserve Board of the Treasury Secretary agreed that risk to the system was not a risk that was worth taking. And so, today I think we can, say that the banking system is sound and resilient, and the steps we took demonstrated that resilience and the safety of deposits around the country.
Mr. Gruenberger, you're aware, are you not, of the fact that the CEO of SVB sold $3.6 million in company stock just 10 days before the bank collapsed and the FDIC took over its deposit? So you're aware of that, right?
I am, Senator.
And are you aware of the fact that other executives of the bank and employees of the bank received bonuses literally hours before SVB collapsed?
Yes, Senator.
Now, I believe we need to have an independent investigation into any criminal culpability, possibility of insider trading in this case. But regardless of any criminal culpability that may be there, I think it's simply wrong, and I think almost every American would agree it's simply wrong for the CEO and top executives to profit from their own mismanagement and then leave FDIC to be holding the bag. Would you agree with that proposition, that that would be wrong?
Yes, Senator.
Now, Dodd-Frank provides clawback authority that applies to the biggest banks under the Orderly Liquidation Authority, under OLA. But as I understand it, that authority does not apply to SVB Bank. Am I right about that?
That is correct, Senator. Could I elaborate on that briefly?
If you could briefly. Just
Very briefly. We do not have explicit clawback authority. We do have an obligation to investigate any misconduct by the board and management of the institution, and we do have authorities to impose consequences, including civil money penalties, restitution, and barring individuals from the business of banking. So we can get at some of the issues raised, but it's true we do not have explicit clawback authority. And I indicated earlier it would be reasonable to create parity between the Dodd-Frank Act and the Federal Deposit Insurance Act in that regard.
There does seem to be a hole in your authority. You have some authorities you indicated, but there is a hole in that authority that we have to plug, and you agree with that?
I do, Senator.
According to the Fed's staff memo, that this guidance was issued upon industry request. And they specifically note the Bank Policy Institute and the American Bankers Association is submitting a petition asking for this rule to provide guidance to try to weaken the punch of the supervisory rules. Are you aware of that?
Yes, Senator.
This goes into the frame that the chairman of the committee made earlier on, where we've got a lot of folks that had been saying for months and years, let's rein in the bank supervisors, and now all of a sudden it's like, where were the supervisors? Why weren't they being more aggressive? Do you agree that that guidance, putting that into rule, sent a message that you don't have to listen to supervisors' guidance that much? And would you be willing to take a look at whether or not that should be repealed?
Senator, I'm not sure of the impact of that guidance. I think it's an appropriate area for us to be looking at. I know that staff are going to be thinking about that with respect to the SVB case, whether it mattered or it didn't matter. I do think it's an appropriate area to look at, but I do not have a firm conclusion about it.
The whole point of 2155 was so that you could tailor your regs and your supervision to risk. So why did you not require definitive corrective action based on the flaws that you saw?
We are looking at the range of tailoring approaches the Federal Reserve took. The decision to set those lines by asset size and other risk factors was made back in 2019. I joined the board in July of 2022 and began looking at that approach.
Okay.
I expect to continue to review it as part of the
Review process.
SVB review, and I believe we have substantial discretion to alter that framework.
Excellent. So you've talked about your review, which is ongoing. In that review, will you take a look at if you used all of the tools in your toolbox to prevent this, both before and after? Will that be part of your review?
Yes, Senator, the staff are reviewing the steps that supervisors took and whether they should have taken more aggressive action.
So at current rate, though, you can't speak to whether or not you utilized all of the powers that were given to you.
I really would like to wait for the formal review for the staff to come evaluate the full supervisory record to make an assessment.
Absolutely.
But we're certainly very focused on that question, and if we didn't do the right steps, we're going to say that.
Here, obviously, that's the Fed, but you are the non-primary supervisor for SVB, or were. Is that correct?
Yes, we have backup supervision.
You have backup supervision. You had that before Dodd-Frank, correct?
Yes.
You had it after Dodd-Frank, correct?
Yes,
And 2155 did not change that responsibility that you had.
that's correct.
Right. So in that role, what did you do prior to the bank's failure to exercise that power?
Yeah, in this instance, we were working with the Fed as the institution was experiencing difficulties, but I think it's fair to say that it was in a supportive role with the primary regulator.
Okay, but you did raise this to the primary regulator. You did exercise
We were
that
working with the
authority.
primary regulator in regard to the institution.
It seems that you failed to put the bank in receivership, and the FDIC passed on allowing the Silicon Valley Bank to be purchased. Is that a correct assessment, or do you feel like that's been incorrectly identified throughout the news cycles?
Yes, Senator. The bank was placed in receivership on Friday morning, and we endeavored to solicit bids over the weekend. As I indicated previously, it was a rapid failure, so there was no opportunity prior to failure to prepare for a resolution. We tried to market it. We got two bids. Neither would have been less costly than liquidation. So we then proceeded to put in place a process where we were able to bid out.
Yes, and I am.
The Dodd-Frank banking reform law included a compensation clawback provision for executives identified as excessive risk takers, or in other words, those who put their banks and the entire economy in jeopardy. Mr. Gruenberg, the FDIC, in conjunction with the other financial regulators, began working on a rule to implement this provision in Dodd-Frank in 2011 and then again in 2016, but a final rule was never issued. Does the FDIC have plans to revisit this rule?
It has been discussed, Senator, and it seems to me appropriate.
So again, Mr. Gruenberg, outside of this rule, tell me, where can Congress step in to stop incentivizing this type of high-risk behavior? Does the FDIC need additional legal tools to hold excessive risk takers accountable?
Thank you, Senator. First, as a matter of law, whenever a bank fails, the FDIC is required to conduct an investigation of the conduct of the board and the executives of the institution, and we have authorities under the law to impose accountability, including civil money penalties, restitution, and barring individuals from the business of banking. So we have significant civil authorities under the law now. It was mentioned earlier, and I think it's appropriate, that we do not have explicit clawback authority in regard to compensation. We can get at that issue through our existing authorities, but certainly providing explicit clawback authority under the Federal Deposit Insurance Act, as the FDIC has under the Dodd-Frank Act, would be appropriate, in addition to completing the rulemaking that you raised previously.
Mr. Gruenberg, does the FDIC have a plan surrounding overdraft and non-sufficient fund fee protections in the event that we experience broader systemic issues?
Senator, you raise an important question. We received your letter. As a starting point, we know there were delays. We really want to get the facts in terms of if overdraft fees were really imposed as a result of those delays. If we can confirm that information, then we can consider what actions to undertake. And we're glad to work with you and your staff as we follow up on that.
Question is, if you find as part of your review that certain individuals were clearly negligent in the performance of their duties, are you willing to recommend they be fired?
Senator, I don't want to prejudge in any way the review. I'm going to get that evidence back. I'm going to understand it fully. And
I said, but if part of your review you find they're negligent, would you recommend they be fired?
It's hard for me to answer in the abstract, sir. I believe we'll take appropriate action with respect to the supervisory structure as a whole, whether with respect
are you willing to, is termination one of the options?
I don't know.
That's an easy question. I just said an option. I'm going to say you have to exercise. Is that an option? Could somebody be fired for this?
I would have to understand the basis in our human resources law.
The bank executives lost their jobs, as should some of these regulators. Shouldn't that be the case if they're asleep at the wheel?
Senator, I want to be very careful. There are laws and procedures with respect to how you treat employees.
You can make a recommendation to HR, and they can tell you whether or not that's allowed or not. I've been in the corporate world for most of my career. I've worked at HR, as is true within the federal government. You can make a recommendation if somebody is asleep at the wheel and negligent.
I would be happy to follow up with you, Senator. I promise we will take appropriate action based on the review, but I don't have a definitive answer for you at this moment.
Vice Chair Barr, did you visit the San Francisco Fed in October of last year?
October last year? What year? I mean, in
2022.
I don't believe so.
Okay, well, the San Francisco Fed published a supervision and brief memo stating the top priorities that you outlined with that visit aligned with their top priorities.
It may be that I did a virtual seminar for a range of supervisors, and so the San Francisco Fed folks were in attendance for that. But I don't believe I was in San Francisco.
So, since you were confirmed in July, what percentage of your time have you spent focusing on climate policy and financial inclusion versus how the Federal Reserve's monetary policy might impact banks like Silicon Valley Bank?
Be as brief as you can in that answer. Thank you.
Senator, I've been focused on risks throughout the system, both short-term and long-term risks. And interest rate risk is a bread and butter issue in banking. It's what our supervisors do all the time.
The Fed knew of problems at the bank dating back to 2019. Were you personally made aware of major deficiencies at Silicon Valley Bank prior to the collapse? And if so, which ones and when were you notified?
Thank you, Senator. The staff made a presentation to the Board of Governors in the middle of February of this year that was focused on interest rate risk broadly in the banking system and how banks and managers and supervisors were addressing those risks. And as part of that presentation, the staff highlighted the interest rate risk that was present at Silicon Valley Bank and indicated that they were in the middle of a further review and expected to be basically coming back to the bank shortly with further information about their status. I believe that is the first time that I was told about interest rate risk at Silicon Valley Bank.
So you were first notified shortly after folks on your staff learned about these deficiencies.
Senator, the supervisors began highlighting these deficiencies at the firm in interest rate risk management and liquidity risk management in a serious way in November of 2021, as far as I know. So about a little bit more than a year prior to that. They intensified that supervisory review as part of its full scope exam in the summer of 2022, when the firm was downgraded for deficiencies in its risk management practices. And they brought those issues again, according to the record, to the CFO of the firm in October and issued additional findings in November of 2022. So that, as far as we know from the current supervisory record, is the picture.
And that's when you were first notified in October and November of 2022?
No, Senator. To the best of my knowledge, I first learned about the issues at Silicon Valley Bank with respect to interest rate risk in mid-February of 2023. So several weeks before the bank failed, staff made a presentation to the board about interest rate risk broadly and with a particular a highlight, if you will, on Silicon Valley Bank, and indicated that they were following up with the bank with further measures.
So your testimony says that asset size is not necessarily an indicator of complexity, and I agree, which is why Section 401 of S 2155 gives the Fed explicit authority to impose the regulations and enhance supervision normally reserved for the largest institutions. And you can do that on any bank between 100 and 250 billion in assets, like SVB. The Fed is given this authority to prevent or mitigate risks to the financial stability of the U.S. We both agree that this is existing authority that the Fed has had since the enactment of S 2155 in 2018, correct?
Yes, the Fed has broad authority to change the rules it uses for different approaches to supervision of firms. Under the rules that were put in place in 2019, the firm was bucketed by a set of categories. I think that it is important to revisit those, as I have been doing since arriving at the Federal Reserve in July.
So given the documented issues that your supervisors found with SVB that we just kind of went over, did the Fed ever consider using its existing Section 401 authority before the failure to more aggressively regulate the bank?
Based on the current supervisory record, it looked like the escalations that had occurred were in the format of MRAs and matters requiring attention and matters requiring immediate attention. And the supervisors also put in place what's called a 4M agreement, which is a limitation on the firm's ability to engage in merger transactions with financial companies.
I think, Vice Chair Barr, you answered Senator Warren saying that you thought banks over $100 billion should have additional prudential requirements. Did I hear that correctly?
I think it's important for us to strengthen capital and liquidity requirements for large banks, really up the spectrum.
Vice Chair Barr, that the 2019, I guess, implementation of Senate Bill 2155, I'm inferring that, bucketed Silicon Valley in a certain regulatory regimen. Did that mean that it restricted it from having supervisors make the judgment that the increased prudential regulations or supervisory functions could not occur?
Senator, we're bound by the rules we put out. So if we want a new framework, we need to change.
2019, different administration, predates your tenure. Are you saying that the promulgation and the implementation of 2155 took certain supervisory or regulatory regimens off the table for Silicon Valley Bank?
The Federal Reserve's implementation in 2019 set basically the standard for how that firm would apply.
Yep.
I think that regulators, supervisors do have judgment,
That's
and they
my point.
can put in place
That's
mitigating
my point,
matters.
because when I hear in your review, will we also have insight into California's role in regulating this bank, or will this be purely federal jurisdiction?
We're looking only at the Federal Reserve. The state of California is initiating its own review.
Well, I think that's going to
to
be very helpful. Supervisors, do we know or have any insight over the past few years if anybody who had worked for the Fed works for this bank? We know that the CEO was on the Fed board, but are on a board at the Fed.
Senator, just with respect to the Class A directors that you mentioned, Class A directors are prohibited from participating in any way in supervision.
When you have a run on a bank like you did with Silicon Valley, could any bank possibly have enough to cover the run? Any bank?
Senator, the particular bank in question is quite unique in its structure, its liability approach, and its interest rate risk management. I can just speak to that particular bank. That particular bank had